In the first low, prices goes outside the Bollinger Band. So we can expect prices to head downward. So this is a price correction. We can expect the prices to touch the upper Bollinger Band. We can also look at another stock, even a 1 hour time frame chart is fair enough. This is called as volatility divergence. Hello everyone, I am Zubin Zaveri with one more video on the Bollinger Band strategy. This time I've come up with a particular concept in Bollinger Band which is called as volatility divergence. I'm sure you all have gone through the previous videos where I've explained what is Bollinger Band, how are they constructed, and I've also discussed some strategies about it. Now in this particular video, I'll discuss one strategy which is called as volatility divergence. So how does it look like? There could be a bullish divergence or bearish divergence. All right. So how would it look like? So let's say this is a lower Bollinger Band. All right. And prices have made a low. In the first low, prices goes outside the Bollinger Band and then returns back to its mean. And after that, when the price makes another low, all right, it does not touch the lower band and bounces back. So my friends, this difference over here, all right, where prices did not touch over here, and in the first scenario prices went below the lower Bollinger Band, this is called as volatility divergence. After you spot a bullish volatility divergence, prices are expected to go up from there on. Above the median line, if the price goes from there on, the prices have a high probability to reach the upper Bollinger Band. All right. Now, just like that, what is a bearish volatility divergence? So, in a bearish volatility divergence, what happens is, if this is a band, prices would keep tagging and go above the upper Bollinger Band and then come below. And after that, the prices may touch a little bit or may not touch and start coming back down. So my friends, this over here where on the second top prices did not touch the upper Bollinger Band is called as volatility divergence, and in this case it's a bearish divergence. So we can expect prices to head downwards. The first target could be its mean and the second target would be its lower Bollinger Band. I hope you have understood this. Let's quickly see how does it look on charts.
So, before we move further, how to find out stocks where there is volatility divergence? Very simple. Come to web.strike.money. Over there in the technical scanner section, we have a Bollinger Band scanner. You select the basket of your choice. You select the time frame chart of your choice. I have selected weekly chart over here, and then select early bands tightening signal. So this will give you a list of stocks where the Bollinger Bands are narrowing down, where there is a high chance of getting a volatility divergence. So over here on the first stock over here, ONGC, you can see that the prices have not touched the lower Bollinger Band during the second low. So that's how you can find out the divergences over here very easily.
I have a trend chart, daily time frame, and have a look at this over here. So prices over here have made one low, all right, and after that what's happened is prices did go up, came back, and in this case it did not even touch the lower Bollinger Band. So this is a volatility divergence, and from there prices went up sharply. Now when it did go up, have a look at this. Prices were over here outside the upper Bollinger Band, and in this places the distance between the upper band and the prices, it kept on increasing. So this is also a form of a bearish volatility divergence. So what happens in this? Prices are expected to revert back to its mean sometime. Yeah, so this is a price correction. After a divergence, there could be a time correction where prices go sideways, or there could be a price correction where prices comes and return down to its mean. This is an example of a time correction. From here on, prices again starts going up. Now it started falling down. The prices have gone outside the lower Bollinger Band, and this time at this particular second low, prices did not touch and bounced back from there on. So over here, if the momentum indicators are all bullish, we can expect the prices to touch the upper Bollinger Band. So this was an example on a daily time frame chart. We can also look at another stock, let's say LNT, and in LNT, let's look at a 30-minute time frame chart. Even a 1 hour time frame chart is fair enough to find out some divergences, volatility divergences. So over here, we can find one. Prices over here were below the lower Bollinger Band, and over here, prices made a new low, but it still did not touch the lower Bollinger Band. So this is a classic example of volatility divergence, bullish volatility divergence. And from there on, the prices did go up, touched the upper band, and the role of this divergence was done. All right. So any time frame chart you go for it, whenever compare the two bottoms, the first top is let's say outside the band, and the second top is inside the band, be it at the top or vice versa. The first bottom would be outside the lower Bollinger Band, and the second bottom would be inside the lower Bollinger Band. So this is a volatility divergence. I hope you loved the concept. Let me know if you find any divergences over here and in the comment section. And don't forget to like, share, and subscribe to this particular channel.